covered call is an options trading strategy that involves holding a position in an underlying security like a stock, and then writing, which is selling, call options on that same underlying security. So it's different than a naked one, which does not mean that you need to hold the actual underlying security. So the call option writer, hopefully you, which is the seller, you keep the premium that is received from selling the call option. And if the price of the underlying security stays below the strike price of that call options through to the expiration day, that call option will expire worthless. And that call option profit for you, it's realized, it's the premium. Make sure you hit subscribe and hit that notification bell so you guys can be notified of new videos that we put up. It really helps us keep producing this kind of content. Now, on the other hand, a covered put, that's an option strategy that involves holding a short position in a security and then writing or selling put options on that same security. And the put option writer is going to receive the premium from selling the puts. And again, if that price of the underlying stays above the strike price of the put option, then it expires worthless and you keep the premium. So just like a covered call, if the price of the underlying asset, we're going to say a stock, moves against the put option writer, you could be assigned on the short position and will be obligated to buy the underlying at whatever the market price is trading at that time. So here, this is a Netflix option chain. Now, look at the bid, ask, and last prices. So this is an example of the premiums that you can receive per share. So $230 strike price. Look at that one. The call buyer could, for example, buy the call for $30 a share. The seller of the option would make a premium of $30 times 100 contracts is $3,000. You can see the potential for a nice income when you trade this way. Okay, so now we know what covered calls are, what covered puts are. Let's discuss when it might make sense to use these kind of strategies. So traders who are neutral to slightly bullish on a stock may write covered calls. And this is a way they can generate additional income from the position that they already hold. So one of the best times to initiate the covered call is when you become a holder of whatever share you're trading. So you, as the seller of that call, you hope that the stock will remain flat or maybe experience a slight decline in value, so the option will expire worthless. Okay, you keep the premium. Another reason why you may use a covered call is more of a hedge against downside risk, so if the market begins to move against your position. So for a trade to be successful, it's really important to select the strike price and the expiration date carefully. The strike price should be above the current market price of the underlying security, so out of the money, because you want to provide yourself some downside protection. So a trader could also use an at-the-money strike price, but only if you believe that stock is not going to jump enough to become deep in the money and be exercised. That expiration date should be far enough out so there is time for that trade to work its full potential, but not so far out that the underlying security is going to experience some big price moves. We don't want that. The best case scenario for you as a covered call seller is a slight increase in the stock price where your stock experienced some gains, but not high enough to trigger an exercise of the option. So in addition to keeping most of that premium, you're also going to increase your bottom line with the asset that you're holding. When you use these properly, covered calls can be an effective way to generate income or a hedge against risk in your portfolio. Stocks, they don't always experience a rapid rise in value the minute you buy them. So if you're holding long-term during flat periods, when you sell a covered call, it's a pretty viable income opportunity. Here's an example. Let's say you're bullish on stock AAA. So you bought 100 shares, and that share price was $50. This is going to cost you $5,000. Now, you believe that the best is yet to come with this stock. So you decide you're going to make some income through premiums. So you sell a covered call, let's say June 17th call, with a strike price of $55 for $2 per share or $200 premium. So you just bought yourself some downside protection. So that stock would have to drop below the price you paid per share minus the premium per share that you received. So it has to drop below $48 for you to lose any money. So let's look at some outcomes that could happen with this trade. So you're right. The stock barely moved during this time. On the day of expiration, the stock price was hovering around the $51 mark. There's really no benefit for the call option to be exercised. So it expires, you keep the stock and the $200 premium. But let's say good news happens in AAA, that stock value rose to $60. Whoever bought that call, they exercised their right to buy the stock from you at the strike price of $55. So now you lose the stock, which has a market value now of $6,000, but you only get $5,500 and you keep the premium of $200. So you've limited your upside gain to the strike price amount, regardless of how high that stock is going to run to the upside. You don't really make any money here. So let's say the stock took a really bad hit on bad news and it went down to $40 per share. So of course that call option buyer is not going to exercise their right to buy the stock from you at the strike price. It's too high, right? But you took a $10 hit on the shares that you bought. You also have the premium. Well, so your loss is the $10 per share minus the $2 premium per share, which you got from the call buyer. So you lost $8 a share. So what about covered put? So these are going to work pretty much the same as a covered call, with one exception. You're selling an option on a stock that you borrowed and then sold on the open market. So what does that mean, borrowing? So we call it a stock borrow, and that's when a trader borrows the shares of stock from the brokerage to sell it short. A trader then could buy additional shares at a lower price to return that borrowed stock. Now, of course, there is nothing free in this world. There's going to be interest and fees charged for your borrowing of that. And writing covered puts against a short position creates an obligation for you to purchase the stock back at the strike price if that contract is exercised. So if you have a flat to a slightly bearish bias and you short the underlying stock, this would be when you would want to consider writing the covered put. So we're going to go to AAA again. It's trading at $100. The trader is bearish on the stock. So you short 100 shares of AAA, and that cost you $100 times 100 equals $10,000. Remember, an options contract has 100 shares. So you want to make some premium income. So you write a covered put at a strike price of $95, and the premium is $5 per share. So that $95, that's the price that you do not expect the stock to fall past. So when you collect that $5 premium, the break-even price for this trade is $105, which is the stock price of $100 plus the $5 premium that you received from the put buyer. So the risk of loss for you could be large if that stock rockets past its break-even price, becomes in the money, gets exercised, and you got to buy the shares at the strike price. So if at expiration the stock market price is below $95, the put writer will make money in a few ways. So the trader shorted the stock at $100. It's now $95 per share or $500 per contract. You also profited with the premium that was paid by the put contract buyer, which is $5 a share or another $500. So your profit total is about $1,000. But there's risks, right? Any options trade, there's risks. So we talk about writing covered calls. If that underlying asset price increases above the strike price of the call, that option could be exercised and you will be forced to sell the asset at the strike price. And you also limit your potential of profit by writing the call to the price of the premium. That's all you're going to make. So overall, selling a covered call is a good way to generate income from an existing long position, but you have to be aware of the potential risks involved and the lack of opportunity for profit. Now, covered puts, these are riskier than covered calls, and that's reflected in the higher premiums, right? There's always the potential for a big loss if the underlying stock price plummets, is trading far below the strike price at expiration, because you're obligated to purchase the shares at the strike price if assigned. So covered calls and covered puts, they function almost the same, one exception. One uses stock that you own and the other one uses stocks that you borrowed. So in a covered call, you're selling an option on a stock that you own. In a covered put, you're selling an option on a stock that you have borrowed. Covered calls, generally less risky than covered puts. Covered puts has a potential for greater losses. But both strategies are going to come with risk, okay? The underlying stock price could move in an unfavorable direction, limiting your potential profit or resulting in a loss. So before you enter any trades, it's really important to understand the substantial risks that are involved and make sure you're comfortable with them, right? You don't need to have tens of thousands of dollars to start trading options. We have this thing called a one-day options trading strategy. You can make money whether that stock goes up, goes down, or even sideways. So it's a free guide that you can download. It's called the 8-Minute Options Cookbook. Totally free. Download to your computer. The link is above and below. And hey, remember, hit subscribe to our channel. If you like this video, please give us a thumbs up. Any questions or comments, you can put them down below. We'll talk to you soon.